Hello, this is Doug Gerlach from iClub Central. Welcome to the Lunchtime Stock Club. Today is Monday, March 14th, 2016. That's Happy Pi Day because it's 3/14, National Day of Celebration for all mathematicians and those of us who appreciate mathematics. So I hope you're having a good day today. We're going to be taking a look at a couple of stocks of interest. We're going to be taking a look at where the market is today and some other updates about iClub Central products and tools. So I'm glad you could join us today on this Pi Day celebration. Before we begin, let's just review some of our housekeeping. Reminder that if you have technical problems, please contact GoToWebinar right away as soon as you experience them at their toll-free number or at their website address. It doesn't do any good to email me after the webinar ends. I won't be able to help you then, but GoToWebinar is standing by to help you right now. If you can't hear me at all during the presentation, or if I drop in and out, my voice sounds choppy, the graphics aren't displaying properly, we always suggest that you turn off any unnecessary programs that might be running on your computer, especially those that might be running in the background that you can check in the Windows system tray. Don't connect using Wi-Fi if you can help it as well, because a wired connection is always going to be much faster. And you can always listen using the telephone, and that will free up your computer to display the graphics as they get sent down the pipeline to your computer. If you have a question, use that questions box in the GoToWebinar application at any point. I'm actively monitoring all the questions, and hopefully at the end we'll have time to address any additional questions that you might have. If you have any stocks of interest, please keep those in mind as well. If we have time, I always like to take a look at those in Toolkit and share your best ideas with our group. The handout for today's presentation is in the Handouts tab there in the GoToWebinar application. So you can click and download that as well. It's a PDF file that you can print right now very quickly or save for future reference as you prefer. That handout will be included with the archived webinar video that'll be available for viewing on demand once we get it uploaded to our hosting facility. Our archives and our upcoming webinars are always listed on iClub.com if you click on the Learning tab. Just a reminder that while our schedule is fairly fixed with our 3 webinars, due to my travel schedule, sometimes those webinars get canceled. Occasionally they get moved around, moved to a different Monday or a different Tuesday, but those will always be included on the schedule there on iClub.com. Now our next webinar coming up is actually tomorrow night. That's our Investment Club webinar on Tuesday, March 15th. Our next Toolkit 6 user group is Tuesday, April 5th, and then we'll be back here for our Lunchtime Stock Club on Monday, April 11th, 2016. So please feel free to join us for any and all of those webinars. We also, oh, let me see, that somebody says there's a PowerPoint file, not a PDF file on the handout. So I'll grab that real quick. Our iClub Central is on Facebook. You can find us at iClub Central, and then I'll give you occasional updates about what we're doing, what our video webinars that get uploaded and when they're available for viewing. So feel free to drop by there and like us on iClub for those occasional updates and occasional special offers that we make available as well to our those who follow us there on Facebook. All right, so I've just re-uploaded the PDF of today's handout. And speaking of special offers, we're celebrating St. Patrick's Day, which will be later this week, of course, with a special offer for StockCentral.com subscriptions. And this offer will get you 15 months for the cost of 12. And that's good for new subscribers as well as renewing subscribers. So it's a way to sample the website if you've never taken advantage of all the tools that we have available there, or extend your subscription and get a couple of extra months as a bonus. Check your email. Those emails went out over the weekend for the link to take advantage of this offer, or you can always contact our customer support team, or you can email me and I'll send you back that link as well. So again, happy St. Patrick's Day for all of you who are Irish or who will be Irish on March 17th. Remember, it takes more than luck to get the green, and with Stock Central, you can take advantage of all sorts of tools that will help you to become more successful investors. So what a year it's been already in 2016. It's good that we're meeting today because we're coming off of a very active week in the market. If you look at the year-to-date market performance for the three market segments that we track, you can see that heading into February, things were not looking so good, but now we've recovered and almost are back to where we were at the start of the year. And even today, well, actually on Friday, things were turned around pretty well. On this graph, we got a couple here on the top. In the blue is the S&P 500, which is up 1.46 or down 1.46% for the year. But you can see it was down quite a bit as of mid-February, and has recovered as well. The next one, the greenish link, is the Morgan Stanley Europe Australasia Far East Index, which is down 2.79%. And the red line is the Russell 2000, which is now down 4.49%, 4.5% or so for the year. But that's up from the Russell 2000 had been down more than 15% for the year. So I think it's much better there as we are heading into the middle of March. We've seen quite a bit of recovery, a lot of uncertainty kind of heading out of the market. If we look at where the S&P 500 is, the PE ratio now is at 22.23, and that's up quite a bit, or actually up, yeah, quite a bit since we met in March. It was at 20.34 in February, rather. So it's up almost 2 points since that time. And that's a reflection of corporate earnings coming in, and the market's still a little soft in terms of overall performance. But you can see that PE level is still pretty elevated compared to where historically it's been on average, as indicated by that red line, where it's sort of peaked at or around this level. Doesn't like to get much above the low 20s for very long at all. And you can see the impact of the 2007, 2008, 2009 market, where the PE ratios jumped enormously because of the significant drop in earnings. And then you can also see the PE ratios peaking during the 1990s bull market as valuations just went through the roof. Earnings coming in still low. They are, for the S&P 500, earnings were $90.27. That's up a bit. So we've had some positive performance since February when they were $90.12. Again, the expectations for fourth quarter earnings were a little lower than things turned out to be. I think something like 60% of companies met or exceeded the analyst expectations for the fourth quarter, and that's about average, somewhere between 55 and 60% of companies meeting the analyst consensus. And so things have turned out to be pretty much as analysts have expected for large cap stock earnings in that fourth quarter. So that doesn't mean that there's a lot of strong profitability that has been reported. When you take out the energy sector and the transports, things get a little bit better. Still a lot of uncertainty in the energy sector. So of course, with the economy, we hope to see those earnings tick back up. You can see they don't always go up and down in a straight line, and still they're stronger than they've been in many, many years, even though they've fallen off a little bit as large cap earnings have dropped a little. So again, mixed signals coming from the market, coming from the economy. when you look at where we stand right now, we're coming off a really strong week. The S&P 500 and the Dow Jones on Friday were at the highest levels of the year. Oil prices and oil futures actually were up last week about 7%. They've down today. They're down a little bit again over concerns about Iran and about the stockpile concerns that we've got so much oil now in stockpile because of the decreased demand. That's going to keep prices down in the future. For the foreseeable future at any rate. Last week there were concerns over some actions by the European Central Bank as well, and so that's kind of roiled the markets in Europe, and that has a ripple effect across the pond as well. But they did signal that they don't think that they're going to be taking much action, much further action in terms of interest rates. And they're suffering from deflation in most of Europe, or what we would call negative inflation. So still concerns in Europe, but for us investors in the U.S., we're still focusing on buying good companies at the right prices. We're still looking at 2016 as being probably another mixed year for the economy, with some recovery. Increasing recovery coming at this sort of snail's pace, and the market reflecting, again, nominal gains, maybe 4, 6, 8% total for the large cap market overall, just keeping pace with corporate earnings growth. And I think that's it's hard to see the confluence of circumstances that might drive the market significantly higher from here, and there's always a chance of perhaps another correction. S&P 500 had been in correction, and now it's kind of bounced out of that phase, but we could certainly see that coming again. So it's been a good month for stock investors, and again, when you look back at all the naysayers in January and February and all the signals and headlines about bear markets, and to see where we stand today in mid-March, it's just a reminder that you got to be in the market in order to make money, even when the market's up and even when the market's down. To that end, let's turn to some words of wisdom, and this time a quote from William Bernstein, who is a former neurologist turned investing writer, money manager, and he made this comment about where the market's going and who claims to know. He says there are two kinds of investors, be they large or small: those who don't know where the market is headed and those who don't know that they don't know. Then again, there's the third type of investor, the investment professional, who indeed knows that he or she doesn't know, but whose livelihood depends upon appearing to know. So hopefully all of you are with me in the camp of investors who don't know where the market is going and are confident that we don't know where the market is going. And we're sure that we don't know. We don't pretend to know. We don't turn to pundits with an expectation that anyone has the answer to where the market may be headed. We might assess some of the information that comes out. We may look and read and understand the forces that drive the market, but we know that ultimately our success is not going to be about knowing the right time to buy or to sell in the overall market, but instead look at individual company performances. If we do have a bear market, we do know, as I always like to say, that eventually it's going to end. All bear markets do end, and that those variables in 2016 may affect the market in the short term, but over the long term, it's the good companies with the good fundamentals that are going to be price leaders when the market recovers, and we've certainly have already seen that. We're going to take a look at some companies today that even in the last 2 weeks have performed well. As I was picking out companies for a recent presentation that had shown some price weakness in the face of strong fundamentals and how they've performed in that period. And certainly that keeps us on track with our long-term objectives. Uncertain times demand certainty in your investing methodology. We want to stay the course, and we want to stick to what we know and what we know that works. We want to stick with our strategy to take advantage of price declines, to take advantage of bear markets, to not fear equity exposure, even when big investment brokerage firms are telling us that we should be moving to the sidelines or moving part of our portfolios to cash. At the Orlando Money Show the week before last, one of my presentations was entitled "Don't Be Bamboozled by Wall Street," where I looked at some of the practices that Wall Street has evolved over the years that serve the primary function of separating investors from their money by suggesting that they buy and sell frequently, but that they take advantage of supposed risk management techniques, which really just drive commissions, where they are doing everything except serve the individual investor, the individual customer's portfolio returns. So we want to be aware of this activity in the market and be the masters of our own money. And that's why Better Investing and the tools that we make at iClub Central are designed to help you take control of your personal portfolio in an active way and be the controllers of your own financial future. Now, we do have, Better Investing did make an announcement last week, and I've alluded to this before, and we've talked about it before, but we have finalized some new definitions for company sizes that we are in the process of rolling out to various iClub Central and Better Investing tools. And so I just wanted to share those with you right now. At Better Investing and at iClub, in our toolkit, in our other web tools, we define company size by annual revenues, not by market cap. Market cap is a measure of the total number of shares outstanding and the total price of those shares. So in a significant sense, market cap measures in popularity. It measures investor sentiment about a particular company. If investors like a business, the price is high, the market cap will go up. But this means that small companies can occasionally have very large market caps. Companies that don't make any money can be considered large companies. And for fundamental investors, this is not a useful categorization. So we look at the annual revenues, either from the last year or the trailing 12 months. And so these definitions need to be updated periodically to take into account the impact of inflation, because $500 million just isn't what it used to be 20 or 30 years ago. So we've rolled out some new classifications for company sizes. We've rolled out and adjusted these company size guidelines. The last time this was done, according to what we can find, was in the 1990s when some very minor adjustments were made. So these are the new definitions that we're using at Better Investing and iClub Central. Now, there are a couple here that we use at iClub in our tools that aren't used at Better Investing, and that's the micro and the mega. But we define a micro company, and this is unchanged, as having annual revenues below $100 million. So this is the more speculative end of the company size range. These are very small companies, so as such, they have very low liquidity and much higher volatility. So a lot of investors like to isolate those, remove them when you're doing screening, remove those micro-sized companies from your consideration. So a small company has revenues below $1 billion now. It used to be $500 million, so now we've jumped up to $1 billion as the top of range for small companies. Then a mid-sized company will have revenues between $1 billion and $10 billion, a large between 10 and 50, and then greater than 50 billion would be a mega cap company. Mega cap, again, we isolate those in the iClub Central tools because these are companies that tend to have very low growth rates that don't always support a growth stock approach. Now, some of them are going to be a little bit bigger and still have significant growth that may support your objectives, but again, it's a way of isolating companies that may be depending more on dividend streams rather than capital appreciation to generate the bulk of their potential investment returns. So these categories, again, we've talked about them for some time. We've toyed with some variances on the amounts, but this is, I think, what we're rolling out. We already started updating some of the web tools that use these company size categorizations in the, for instance, portfolio reports that subtotal by company size. And we are also updating Toolkit, because we have a portfolio report there that breaks down your portfolio by company size. So that Toolkit update should be coming out in the next couple of weeks as well. On the Better Investing side, they have, again, a portfolio report, I believe, that will include these definitions. And again, these are loose categories. These are not hard and fast guidelines. Better Investing suggests that of your total portfolio, about 50% should be in mid-sized companies, 25% in small, and 25% in large. And the reason for that is to help you focus on companies that have the highest prospects for capital appreciation, which is the key objective of a growth stock approach. When you're investing in companies that are very large, again, you don't have the capital appreciation potential there. You're focusing on buying them when they're undervalued, and also potentially some of the dividend yield that can boost those returns and help you meet your overall portfolio objectives. On the small side, again, you don't want to overload in small company stocks necessarily because of the increased risk that comes from investing in those smaller companies. Now, over time, that risk might become mitigated and acceptable, because small caps are definitely going to give you a much higher total rate of return, but they just give you a lot more volatility than their mid-sized and larger companies in a portfolio. So, but I'm not going to argue with anyone who says small, $1 billion is too small or too large. You can kind of use this as a target framework, not strict boundaries for the company size. For most clubs, I like to, and most individual investors who are members of Better Investing, the definition of a small company is one that's probably a whole lot smaller than most of the companies you own right now. If, like most clubs and individual investors, you are investing in growth stocks, chances are you're skewing towards the high end of the mid-sized range and the large company range, the brand name companies, the very popular stocks, not the lesser known companies that may offer even better growth prospects and valuation prospects at their current size. So I like to recommend that investors keep looking small, looking towards the smaller end of the company sizes for new opportunities in their portfolios. So now we're going to take a look at a couple of stocks that I've been talking about the last couple of weeks as we that I've pulled out of our Small Cap Informer and Investor Advisory Service newsletter. It's interesting today as I looked at some of these stocks that I've been talking about to see how much they've gone up in the last couple of weeks. Again, that rising market lifts all ships, but in some cases it lifts the more efficient ships a little bit better than those that perhaps are a little more laden with negative attributes, and that's the whole objective of a growth stock portfolio. Is when you select those individual companies, you're going to select those that have the better prospects for outperforming the market when it goes up, and they may or may not outperform or underperform the market when it goes down, but we're really capturing that outperformance objective as we go. So as I mentioned a week and a half ago, I was at the World Money Show in Orlando, gave a couple of presentations, sat on a panel, talked with investors, and I did present a small cap stock clinic. So on March 3rd, when I presented those stocks, the 5 stocks that I picked out of our newsletters were Air Lease, ticker AL, Columbia Banking, ticker COLB, Drew Industries, ticker DW, PRXL, ticker PRXL, and SSNC Technology, ticker SSNC. And you can see how their prices have performed since that time, with Air Lease up 4%, Columbia Banking up 2.4%, Drew Industries up 4.4%, PRXL up 2.67%, and SSNC up just 0.4%. Those are intraday prices as of today, March 14th. But still, that's a pretty good return for less than 2 weeks. 9 days, 11 days in the market. And again, because things had been beaten down. I selected these stocks because they were well off their 52-week highs, but yet the fundamentals seem to support a better valuation than the market had been giving them at the time in early March. And so I just thought I would just review them. I'm not going to talk about Air Lease. We talked about Air Lease a lot. I love Air Lease and its potential. I love their business model. I love their improving fundamentals, and the valuation right now I think is really solid. It's just a real attractive stock to be part of any investor's portfolio right now. I think the downside's been much amplified and somewhat out of proportion to the underlying fundamental strengths. And even this company, just a couple of years since they went public, it's already showing signs of just top-notch management, flexible, responding to trends, doing everything that we look to public companies management to deliver on. So we're not going to talk about today, but I will quickly go over these next 4 companies, which I think are still all in the buy zone and delivering a total return that is pretty attractive at the current rates. Again, we're not shooting for the bleachers here. We're just trying to get a lot of base hits, and I think these 4 companies will help you with that. Columbia Banking, we cover in our small cap informer. This is a regional bank in the Pacific Northwest, so they're out in Washington State, Oregon, getting into Idaho. They're growing organically, but they're also acquiring branches from national banks and from other smaller regional banks, and that's helping fuel a little bit of growth. That's a very strong area of economic growth in the country, the Pacific Northwest, driven by technology. Both Portland and Seattle have very strong technology industries. There's some rural areas in both those states that are a little more affected by the economic downturn, but overall, that portion of the country offers some good economic opportunities. Current price is about $30, and the PE is 17.7, which is pretty high for a bank, for a financial stock. The current yield is 2.4% though, so you are getting a good dividend. This stock had been as high as $36 in November, so they pulled back quite a bit to get to $30. They were closer to 27, 28, 29 just a couple of weeks ago. See them as a buy up to $32. We're projecting 11% growth. That plus the dividend plus the valuation, the low valuation will get you to just about a 15% total annual return if our assumptions are right. Columbia Bank has been named to the Forbes magazine's list of America's best banks for the last several years. I think they were just like number 9 in the one issue that came out in January. You can see good fundamental strength. We're focusing on the pre-financial meltdown period. So you can see sales revenues just growing nicely and profitability increasing on very stable earnings growth. And so just some trends that we like to see there. Looks pretty good. And that price really on the 52-week high-low is currently at the low end of the 52-week high-low range, which is another aspect that we like here. And here's something else. We took a look at the technicals. So here's the 52-week price chart with the 50-week simple moving average in black and the 200-day simple moving average in gray. So when you see that blue price line cross over the black or the gray moving average lines heading up, that's a bullish sign. So when I looked at this 9 days ago, Columbia was below their 50-day moving average, and you can see they've reached it and dropped back down and then came back up again. So that's a bullish technical indicator that would seem to indicate this is a good time fundamentally and technically to get into the stock. This is something we've been taking a look at. This comes from our equity research service website, where we have a technical graph and we give you some of the key indicators and we give you the trends. So it makes it very easy, an easy way to start implementing some of the technical considerations into your stock analysis if you wish to do that. And the understanding is that even if you have a great stock and you're right about the fundamentals, if the rest of the market is negative on the price, then you're going to be sitting holding that stock for a while, waiting for the price to go up. So this is suggesting that the price is on an uptrend for Columbia Banking. For Drew Industries, this is a little a success story for us in our Small Cap Informer newsletter. They make parts and enhancement features for recreational vehicles, so both in the manufacturer and in the aftermarket. And this has just been a growing area in the United States. Traditionally, you would consider the RV industry to be sensitive to the consumer, to the economy, the overall economy, in that if we're in recession mode, people are not spending lots of money on their recreational vehicles. But that trend has been softening in the last couple of decades. I think as people are looking at RVs as a replacement for the second home, it provides mobility. You see seniors retiring and purchasing an RV and spending considerable amounts of time on the road in their own RV, and so it's become less of a optional consideration and more of something that you purchase, you maintain, you upgrade and enhance, and perhaps during economic hard times, maybe you defer upgrading your RV, but you still spend some time and some money, some resources on improving your current one. So Drew kind of fits into both of those trends a little bit. Current price today, just under $63. The PE is 20. There's no yield for this stock. In last March, they had been up as high as 65, so they were down below 60 at the start of the month. So they've come back quite a bit there. We see the buy up to $70, and earnings per share growth, we're looking at 15%, fueled organically and by acquisitions. Drew's been really smart about acquiring some of the smaller component makers that fit into their business model. And that's really helping deliver some additional profitability. From the current price, it's just under a 17% total return. Company had just delivered their fourth quarter results, and again, we're just really strong, and that just gives us a lot of optimism in the company. You can see here our 15% growth there, and now the price is back up closer to its 52-week high and low, but just a great consistent performance post-recession, and as they have been driving forward and actually seeing their growth rate improve instead of decline as they get bigger. It is a somewhat bigger company than we tend to follow, $1.4 billion, but again, so more of a mid-sized company perhaps, and you can see here that not too long ago the price went above both the 50 and the 200-day moving average on a really strong uptrend. And there on this company, if you look down below into the relative strength and the money flow indicator, the pink and green lines down below, these are actually, let me show you right here. You can see those areas are actually, those indicators are actually in an oversold condition right now. Here, let me circle them in orange so you can see. So they're both a little high, which is something of a bearish trend for the stock. You can see here where the price jumped through, broke through those moving average lines. So a lot of support going forward. Less technical support for Drew at the current price. I would definitely buy it, be a buyer on a dip, as opposed to putting a lot into it right now from a technical perspective. But the technical, the fundamentals still pretty strong for this particular company. PRXL International is a pharmaceutical diagnostics and research firm. They do contract research for other pharmaceutical firms. Their current price is just under $62, current PE of 23. They have been as high back in August as $76. We have them as a buy currently up to $70 on 14% earnings growth, and we've ratcheted that back down a little bit. So I think it's pretty conservative. A conservative approach. So that's my growth rate projection. We track it. Our analysts in the Investor Advisory Service also track it, and they're a little more optimistic. But even at that current price, that's just about an 18% annual return. Here you can see PRXL's results. A little bit of a slowdown in the sales growth. You can kind of see that trend. It's been about 12% over the last over the last. We're going 6 years since 2009. We're really tracking that period. But you can see the analyst estimates here and that softening sales trend that I indicated in the last couple of quarters. But profitability is still up, earnings still up, and so we think it's probably got a good opportunity. You can see the current price over here, well below the 52-week high in this. Right here, you can see that current price at a 52 near the 52-week high. So again, it's come back a little bit, and it's delivering, as you see on the price chart here, a lot of price weakness as that price has really declined. But the interesting thing is where we are right now. So it looks like we're just about to breach that 50-day moving average line going up, and that would provide stronger technical support for PRXL's price moving forward. And so this is the opportunity to get in at a really, perhaps a really good time on the technical side, and that would, again, assuming that our fundamental assessment is correct, we'd be buying at a good opportunity right now. And then my final stock is SSNC Technologies, ticker SSNC. This is a company that makes financial industry software for hedge funds and money managers to do back office compliance, customer statements, etc. So they provide the systems that investment managers use. Current price is $61, current PE is 22, current yield, very small, but just under 1% at 0.8%, has been as high as $77 in November, and now back down to 61. We see them as a buy up to just about $70 right now for a 21% total return on 15% earnings growth. Now, the company has had a little bit of fundamental weakness lately, but it's all a known issue. The company has sort of been transforming its business. It's made some acquisitions, and they see 2015 as a transformational year, and they really have provided some positive guidance for 2016. So there's a lot of positives in the SSNC story going forward. Here you can see that graph went public in 2010, just over $1 billion in revenues last year. You can see our trend line in the next couple of years, really intersecting with what the analysts are expecting for this company performance. So we see that there's quite a bit of opportunity for this company to just continue to chug along, doing exactly what they do. You can see, we can't see on this graph how they might perform during a bear market when interest in financial stocks might decline. Again, this is a technology stock, it's an IT stock, but because it's related to the financial industry, it's subject to a lot of the same trends that might affect those financial stocks as we go forward. On the technical side, you can see again, 9 days ago, SSNC had not yet breached that 50-day moving average, and today it has. It's gone up and it's come back down. It's breached it in the other direction, as you can see over here. So I guess you might say it's not breached that 50-day moving average line with conviction just yet, but it's certainly not showing necessarily a bearish indicator either. You can see how that price trend the price has fallen in the last couple of months since it reached that 52-week high, bounced around up there in the mid 70s. And now here we are just above $60 and looking fundamentally strong, and hopefully it will continue to deliver that return over the long term. So just to reiterate, as we try to incorporate some of these technical tools, we're not saying that we're going to rely on them, but if you've got a choice between a couple of different investment opportunities and the fundamentals are equally strong for each, then choosing the one that the rest of the market seems to be looking towards as having the better near-term price mobility opportunities might be a valid reason to help sway your decision towards one stock or the other. That's all we're saying. We're not turning into market technicians. We're just trying to introduce and incorporate. As I said, if you go to our ERS website, we give you the explanations of some of those key indicators as and whether they're bearish or bullish and how old they are, and that is again helps you to understand them. We also have technical tools on Stock Central, and we've had Saul Seinberg did a couple of webinars which are available for viewing from Stock Central that will help you learn a little bit more about some of the trends and how to interpret the technical price charts. So now, if there are any stocks that you're buying, or if you have any questions, feel free to put them in right now. Bruce asked if the new company size guidelines are in effect with iClub and Better Investing. These are all being rolled out right now, so I can't give you a tool-by-tool answer. We've been working on it on the iClub side, so I think a lot of the definitions have been updated there. On the BI side, I don't know what they're doing there. And in Toolkit, we haven't yet released the update. We're testing it right now, so we have the update built. We're testing it, and then we'll be releasing it hopefully in the next couple of weeks. Gary or Jerry says, what order method do clubs use to purchase stocks? Limit, market, stop limit, etc. It's a great question. I think most clubs and Better Investing investors, by and large, are using market orders. Market orders traditionally have been less expensive than limit orders. Some brokers charge extra for limit orders. So I think the traditional method is market orders, because we're not counting the pennies in our total return. We're just trying to, if we buy the stock at any point below the buy price, then our 5-year potential is still going to be solid, no matter if we pay $1 more or less. Still going to be in the same ballpark going forward as the fundamentals continue to drive the price upward. So having said that, if we are at that point where we are very close to the buy range and you're feeling like the stock is a little less liquid and there's a little more fluctuation in the daily stock price, you might want to use limit orders. On the sell side, my club uses trailing stop loss orders that we set on a periodic basis, particularly the stocks that we own that have shown large unrealized gains. We may set a trailing stop loss of between 5 and 10%, so that if there is a general market decline, those stocks would be sold and would protect the gains that we'd already earned. We don't do that on every stock. We might apply them more to smaller, more volatile companies as opposed to larger, more established businesses. We've kind of taken on a company by company basis. But that's one way that, particularly in the tail end of a bull market, as valuations get stretched out, that some investors like to kind of add that as an additional insurance. The problem with trailing stop loss orders and stop losses in general, when you're selling stocks based on a decline, if we have an overall market decline, of 10%, that could come very quickly. It's happened in the past where the market might decline 10%, or maybe your stock will decline 10%, and then a couple of days later, we'll have recovered all that 10% and maybe a little bit more. So the net result of your stop loss order is a capital gains bill that now you must pay, maybe at a short-term rate even, where it's a little bit higher. If you didn't have that stop loss, then that market decline would have not affected you at all, and you would continue to, now if you want to buy the stock back, you can buy the stock back. You have to pay a higher price. It may still be in your buy range, but that's just something that's a risk of those types of orders. Hugh asks, is it a good idea to always put in a limit order when buying a new stock? My answer would be no. It's not important. I would consider it optional. If your broker, in my club, when we make a motion to buy a share of stock, that buy price is pretty much dictated by the stock selection guide. So if the stock selection guide says it's a buy up to $77 and it's currently $72, we instruct the treasurer to buy, our 50 shares up to, at a price not to exceed $77, or maybe we'll say $74, whatever the motion is, whatever the person, wants to add in a margin of safety, the person making the motion. And then we leave it to the treasurer if it looks like we can't, the execution might be higher than $74 that the motion stipulated, then we might use a limited order. But we'd feel pretty silly if we had done that and the stock got to $74.25 and then 3 weeks later was at $78 and we missed out because of 25 cents. We missed out on all that return. We'd feel pretty silly. So that's another downside of using limit orders when you're making purchases. With our long-term perspective, we don't need to manage down to even to the dollars of our share price purchases. We have the luxury of having time for our picks to work out, for the fundamentals to catch up, and even if we don't have the absolute lowest price that we could have, we're still going to come out ahead over time. All right, so let's take a look at let me fire up my toolkit here. Joe says, take a look at PAYC, P-A-Y-C. I'm guessing that's, well, hold on just a second. We'll go ahead and download it from our data. Paycom software. Oh yeah. We'll enter our own judgment here. So definitely went public in 2014, $224 million in sales. I've looked at this in terms of as a candidate for our small cap informer. Didn't make any decisions about it, or we haven't yet begun to cover it. So I'll take out this 2012. It looks like the earnings may have gone negative or very low. So sales have been growing 40% on average since 2011. As you can see, just let me point out here, 2014, we have our first price data. So that's when we can assume that the company went public, but we have data over here for 2011. And that means that that's not uncommon for companies that go public to provide pro forma financial statements going back prior to 2014, in this case 2013, 2012, 2011. And you'll also see that we have earnings per share in 2013, even though the stock had not been trading publicly. And again, that's pro forma. So the company goes back and says, if we had shares outstanding then, this is what the earnings would have been based on our results at that time. So that's what we're looking at here. For future growth, no analyst estimates in the data file. We'll cap it at 20%, even though the company has grown faster than that in the last few years. If we look at, I'm going to look at the historical growth. We can see that, yeah, sales growth has been pretty consistent at 40 to 48%. And earnings growth, you know, again, not a lot of data there, so we don't see a lot of fluctuation. Okay, so we'll just pop in 20%, you know, as an aggressive choice for the company. Earnings grew 95%, right? Earnings grew 95% in the fourth quarter. Sales grew 47% in the fourth quarter. So that would provide support for our 20% expectation, perhaps. You can see the current price halfway between the 52-week high and low price over here. So that's telling us that stock's been higher, but it's also been lower in the last 52 weeks. Not a lot of price history, but that gives us a little extra to go on. All right, so in the technology, this is a software company, so we have to look specifically at what they do. We can always take a look at that. But we'll just kind of figure out here what it looks like on a fundamental basis. We do see at the top that 13% of the companies is held by insiders, which is pretty good. 70% by institutions, which is not to be expected. Many of them may still be holding it from when it went public. All right, we'll flip over to the back. Margins trending upward again. So last year, just under 15%. So we want to compare that against some of the peers. Yeah, definitely a positive trend. With such limited data, my take on the pre-tax profit margin growth at this point is that we really want to understand how this compares to other businesses, and it may be lower than more established companies, and again, that we would just kind of take that under consideration. There's no pre-tax return on equity because we don't have enough data, and debt, a little bit of debt, you know, kind of coming down to 26% last year. So we like that downtrend. That's a lot of debt though, but as part of their capitalization plan, maybe debt is incorporated in. It's not common for technology, for software companies to have a high load of debt. So I'd want to understand what they're doing with that, with the money that they're borrowing there. So here's where it gets tricky. Our PE ratios are just through the roof. You look at the high PE ratios here and the low, average high 199, average low 87. Current PE ratio 87.8, even projected 73.2 over here. So very high valuations, not uncommon. The market is expecting much higher than 20% growth probably to justify those high PE ratios. There might also be some low liquidity, so there's not a lot of activity in the stock driving it up or down. If we look, and at this point, you know, we're just gonna get. I'd be surprised if we can get this into the buy range. At 20% growth, our maximum high PE ratio we would select would be about 30. On the low side, maybe 15 would be the lowest we'd expect the company to sell at. And that then our low price is $5.04, and its current price is $32. So it's just really low. We might adjust to take our price variant quotient price 21 or our 80% of current price at 25. I'll say $21 just for the sake of argument. And you can see here it's even that doesn't get us into anywhere close to a buy. So the assumption would be, over the long term, we'd have to see much higher than 20% growth, and those P ratios are going to contract. You can already see they're coming down. 269 to 128. They're really coming down quite a bit. There we can see it better here. You can see they've already contracted, and they're the 52-week high and low PE ranges from 127 to 61, so pretty close to where it was in all of 2015. So interesting fundamentals. I just want to know, again, at this point, this might be one of those risky, those 5% of your portfolio stocks that you might invest in a little bit, looking at what growth might be for the next couple of quarters. Oh, you know what? Let's take a look at what the analysts might say, and then we'll wrap up. So if we go look at Yahoo, just to see if there are any analysts. So we've got a couple of analysts, a lot of analysts actually, 10 analysts covering the company, seeing 53 cents and 73 cents for earnings in the next couple of years. And sales of 310 to 401 million. So 310 and 401. So you can see, so right away, we've got 73 cents in earnings expected in fiscal 2017, which would put our 90 cent projection much lower. So, earnings might be really closer to 5-year earnings. 20% from 73 might get you much closer to $1.50 or $2, somewhere in that range by 2020. And so that might help justify a long-term consideration right now. But that P ratio, is just really so high right now. I think this is why we've never recommended it in the small cap informer. Even the fundamentals are strong, the valuation is just way out of whack, which is not uncommon, but not the kind of stock that we like to buy. All right, let's wrap up. We're at almost at the end of our appointed hour. I will be back in Florida on April 2nd in the Fort Lauderdale area, in Plantation, Florida, specifically for the Southeast Florida Better Investing Chapter's Investor Education Day. It's just going to be me. I have 4 classes scheduled from 8:30 to 1:30 essentially, and a very reasonable price. So if you're within driving distance of Fort Lauderdale, check that out on Saturday morning, April 2nd. Then in April 16th, I'll be out in Portland, Oregon for their Investor Education Day on that Saturday. It's also a Saturday, giving a couple of presentations, going to sit on a panel discussion as well. And then in May, I'll be at the Better Investing Convention in Chantilly, Virginia. So this is near Dulles Airport. And registrations are really strong. The conference hasn't been in that area in a while, so it's very accessible for a lot of the East Coast to get to the Washington, D.C. area. And I've got a couple of classes and presentations on the agenda, the conference agenda at that Better Investing National Conference. As always, there's my email address, gerlach@iclub.com, so feel free to send me any questions if you'd like more about our St. Patrick's Day promotion that I mentioned earlier. Feel free to email me if you can't find that link, and I will send you the details on how to extend or sign up for Stock Central with that promotion that we've got going for other users of other iClub Central tools. So I hope the rest of March is profitable for you and your portfolio, and we'll look forward at seeing you back here in April at our next Lunchtime Stock Club.